Hi, Pat Moran from Healthier Money. I'm with Mark from Sterling Accounting, would you say?
Sterling Accounting and Tax.
Okay, and so talking to Mark, one of the things that I've been had the pleasure of developing a friendship here with Mark over the last year, and in particular, I know you've been very successful at the things that you've done, and I thought it was interesting talking about with your accounting practice. I asked you a question like, "What drives you nuts?" And it was funny because you touched on something that was really prevalent to me. Why don't you talk a little bit more about that?
You know, I see a lot of people who, when they want to start a business, they just form the business and they say, I'm in business. I say, great. But they don't come to me until the end of the year, and they've been a sole proprietorship all year. So, because it's really easy to form because you don't really have to do anything. They normally operate out of their same bank account and then running personal and business all together.
Right.
But then at the end of the year, when they see that they've made X amount of dollars, and then when we go to fill out the return, it shows, hey, I've got X amount of dollars in profit, and you got to pay all this self-employment tax extra.
Right.
So there's really, it's hard to plan with people like that. Unless you get a right entity set up for them properly. You know, a lot of people are doing LLCs, taxing them as S corporations, paying themselves reasonable salaries, and not having to pay tax on the full amount of the additional self-employment tax.
So a couple things about that too. When you go, isn't it true then by having that kind of entity, you're really adding another veil of protection?
Well, yeah, I mean, and the attorneys will tell you, there's a liability protection as well as the tax savings.
Okay.
So the people say, hey, some people like to do it for the tax savings only, and that's kind of what we focus on. And then the bonus is the liability protection.
And then when you go down that path, and it is the end of the year, and you have unfortunately that conversation where they've got that 15% self-employment tax, how many people have actually prepared to pay for that?
Oh, none. Because they have no idea. They weren't expecting that either. And that's the other surprise. And then they say, oh my gosh, what do you mean? What can I do to fix it? Can I go back in time?
Right.
And some people had LLCs formed in the past and were able to do some stuff with late elections and different things like that if they operated through the proper way. But it gets a little tricky because you want to stay, if they get audited, you want to make sure they have all the right documentation and everything to support everything they're putting on their tax return.
Right. And I thought it was interesting that you really hit on a nice hot button for myself about the Trump tax return and the lower tax brackets and the things that we're in with tax savings. Why don't you expand on that a little bit?
We go through a lot of analysis with our clients. So when the return's done, we show them comparison. Here's last year, here's this year, look at the differences, and we show the tax rates. So I see a lot of people who in 2018 who earned $100,000, and in 2019 they might have earned $150,000, but they paid less percentage in tax.
Sure.
But they say, well, I paid more tax, and I said, you paid more tax because you made more money.
Right.
But it's a less bracket. They said, well, that's not right. And so I get that. People, it's not a Trump tax. It's the tax law.
Okay.
So whether you like them, don't like them, it doesn't matter. If you're paying less tax, you should like that, unless you'd like to volunteer to pay more tax.
Right. I think that you have a legal responsibility to try to minimize your tax maybe as much as possible. Have you seen people too take advantage of, maybe they're sitting with a lot of money in their IRAs and things, and they're letting them grow tax deferred, and now there's that ability to really take some healthy distributions and in theory pay a low tax on it compared to where we've been.
Right, I see that. I see people who are, when they retire and they have no other income, and we're working with people to say how much can they take to still stay under the threshold, to still maintain the low tax rate when they pull the money out.
Okay. Yeah, I think that's a valuable planning tool, and one thing that we stress a lot that people just aren't taking advantage of. And it's funny, I think you've been an accountant for many years. What would you say about where we are right now with tax brackets? Are we truly at a historical low? Is this a good time?
I think this is the time, for me, I've done this 36 years. I don't remember it being as low as an effective rate than now. I mean, you have so many different ways to reduce your tax, and if you do the proper planning, you can set money aside for retirement easier than you could have in the past, and there's more avenues to do so too. Sure. So I think this is like one of the best situations we can be in a very, very long time.
Then the other thing I want to talk about is you've had great success in just saving and plotting and investing your money and being smart with it. What would you say to those people that really kind of are behind the eight ball maybe a little bit now, but also, retirement's looming and savings looming. What are some of the principles that you adhere to in your own personal situation that maybe people could benefit from?
Well, if all or nothing isn't so good, because people want to say, oh, I'm going to wait till I have everything saved up and then do something.
Right.
So we tell them, just start with something. Just start doing it and then start increasing it and have a goal. Have your short-term goal of how much money you're going to put aside. I mean, some people are putting aside, $50 a month, $100 a month. I said, that's great. So then they get to say, now look what you have. And they say, well, I could do another 200. Hey, I just got this raise. So by the time you look at it, then they've got 20 grand, 30 grand, 40 grand built up after a couple of years. And they're like, well, this is pretty cool. So then so little by little and just keep increasing it and don't touch it. Just because you want to buy a car, don't go and just say, hey, I've saved 40 grand, I'm going to take the 40 grand out and go buy my new used BMW.
Right. Well, I think it's interesting what you touched on. There's a lot that we're taught that, it's accumulation, defer. And I think one of the things that you touched upon is having those buckets and realizing that, maybe putting it all away for deferral isn't going to make as much sense. At the first sign of trouble, you get sick or hurt. You're going to be facing all these taxes and potential penalties and things. So that bucket approach, I think, is really important. Is there anything else maybe that you're telling your business clients as far as what they should be doing?
Well, I'm in the form of savings. We're trying to have it to where they have enough working capital so they don't spend it all down to nothing, and then to allow for some of the downtime, to make sure all of their employees are employees versus contract labor, what the proper thing is, because IRS is really hammering that these days.
Okay.
Looking at setting up proper retirement plans and other things to retain employees.
Okay.
To some other benefits, whether it's health insurance, whether it's whatever. Most aren't doing health insurance. Small businesses, because they can't afford it.
Split dollar or any of that kind of stuff?
Don't have very many people doing that right now.
Okay.
Should they be doing it? Sure. Do they understand it? No.
Okay. I think that's the big issue. It's
Yeah.
It's the fact that I think people are, we've been taught this small little box, and now, there's so many other things that we can be doing, and split dollar with, the ability to take, maybe have a tax-free retirement and, have insurance and some of these other things. There's a lot of benefit to things like that. Have you ever done any of that with some of your clients or recommended that?
We've recommended. One of the things I tell clients, and we know our limits because we are tax people.
Sure.
But we tell, if there's so many things that can be coupled with insurance as an investment that makes sense, rather than just saying, hey, I'm going to put money in a CD or because I feel comfortable, or I'm going to buy this one stock. I'll open my Fidelity account and buy one stock or something. It's going to go up. It's going to go up.
Right.
So I said, so leveraging, looking at the investment pyramid. I go back to the whole, the basics, and say, what do you want your portfolio to look like? If you have 90% of it in cash and you're right at the bottom with the low risk, I said, what do you expect your returns to be?
Right.
So if you can spread that out a little bit, and I tell business owners, I said, you're a business owner, you are not risk averse. I mean, as an entrepreneur, you're taking risks. So and depending how old they are is going to be another big factor, because the older they are, the less time they have to recoup. So if they can start off when they're younger, and they can start putting money aside. I bought my disability insurance policy when I was 19.
Wow.
It's an own occupation policy, and I still have that. And so I tell people, I said, one of the first things is make sure you have plenty of insurance.
Right.
I said, I hope you never use it, but you need it. When you need it, you're going to need it. And I've seen people that needed it and didn't have it.
Well, and you're your most valuable asset. You're the best check you have is your ability to make income, bring it in. So that's. I ran into another person, ironically, who bought his first disability policy at 20, and now he's 61, and he still has it, So I see those from time to time, and I think it's so important, that ability to insure your income. You've had great success with real estate, and I know that's one of your passions. Talk to me a little bit about how you got started in that. What are some of the things that you really like to focus on when it comes to real estate investing?
We like things that make us feel good, and I'll qualify by saying, we are one part of what we do is we invest in 4plexes and 6plexes in some of the low-income areas for people who are either single families or single moms, veterans, homeless. And then we work with these nonprofits that help fund these places for them to live. So we get in, we buy the properties, we fix them up, and then it provides a nice place for them to be. And then we're collecting fair market rent from the nonprofits to help, cover the cost and everything that we've had too. And
how's the appreciation on those? Is it more so an income play as opposed to appreciation, or they're appreciating doing well?
It's both, because it depends the area you're buying in too. Okay. So some of these areas that like downtown Phoenix, for example, they're being revitalized, and different areas. So it might be 20 years before it really gets up there. But right now the market is so strong. The rentals are good. So right now it's kind of an income play. When we look at investments, on the real estate side, we were looking at how much money do we have to put down, and how much money can we make on that money, and it doesn't have to be some big number, but we were finding an average of between 20 to 28% was our average annual return, cash on cash.
That's awesome.
So if we could put less money down, and with the financing rates really low right now, and after debt service and everything, still maintain that ratio. That was a good ploy for us. So we were able to use part of our portfolio in real estate as that, and I consider that kind of moderate to almost a little risky.
Is that more of your growth in part of your portfolio, or are you really in the market and things like that as well?
I'm in the market too, because I'd say that's a little more risky than the real estate would be.
Right.
So I mean, the real estate's more kind of a constant. We know we have leases, we have long-term leases with a lot of the commercial properties. But I got involved. I love going into a piece of property, looking at it, seeing what it can do, without getting attached to it. Because you don't want to get really emotional about it. It's a widget,
right?
And you say, okay, hey, here's this, and if the property looks decent, is solid enough, then it's something we like to play with.
Yeah, you were saying earlier about anything down here in Maricopa or Phoenix, just with the population growth.
It's booming. It's booming, and we were and some things are just way out of price range right now.
Does that concern you at all?
No,
not really. Getting ahead of themselves.
I mean, everything's going to correct at some point, but as long as you don't buy at the very, very, very top, or way overpay for something that you can do then you're better off.
Sure.
But we look at it as, if we buy a piece of property and the rents are coming in, no matter if the property goes down in value or not, we're still collecting the same rents and we still have the same debt.
Mm-hmm.
So we're not really losing out. If we, because we can keep holding on to it and still collecting the rent and having the income and have time to wait for it to come back up.
Out of curiosity, are you owning each one of those in its own LLC?
We do, and most of them have, we have a group of 2 or 3 of us that are like the stable core group of partners, and then we'll take on 1 or 2 here and there depending on what project we're doing, depending if it's a bigger dollar type of project, or if it's something a different person refers to us, we'll include them as well.
I think it was a great point that real estate came later on down the road. The fact that you really got your house in order with insurance and protecting yourselves. A lot of times we see business owners that are working really well on their business, are working well in their business. They're not working on their business,
right.
And we don't see the basics of insurance. We don't see some of the planning that they want to do, and every business owner, unfortunately, that I talk to, most of them are like, oh, I'm going to build this thing up, and then I'm going to have this great exit. I'm going to ride off into the sunset, and yet everyone I talk to never gets that great exit.
That's so true. And you're right. That's exactly what happens.
So I think that it's very important, like you said, the most important bill is yourself. And if you always wait till the end of the month, there's nothing ever left over. So
if you build the foundation and you have everything, your ducks in a row, let's say, then you start building on it, and it's so much more stable, and then you don't have to be running around. It's kind of like if you have a kid when you're 16 versus have a kid when you're 30.
Right.
When you're 16, you're trying to find where's your next dollar coming from, for income, and when you're 30, you've got yourself established. Right. Same principle.
Yeah, I think you and I had kids later on in life.
That's right. Late 30s for me.
Same with me. So ironically. But anything else that, as we come into this tax time right now, any tax advice you'd like to give to people? Here we are, rolling into another tax, season. What are some of the things that you're really impressing upon your clients, and some of the things that you're trying to do a better job of helping people get more organized?
Well, people who are selling properties or selling stocks and have lots of capital gain, people are trying to decide whether they do a 1031 and try to roll over the gain
Sure.
versus not. And with the tax rate so low, and knowing the potential that it could go high depending on the next election, I'm telling people, to really think about paying the tax now instead of waiting and deferring it and trying to pay a higher tax later.
Right.
So that's another thing. Again, it's personal preference, and we try to advise people of the options. If you pay it now, here it's this. If you wait, we don't know. So you can only judge and you can only do tax planning based on current law,
That's
not
true.
what ifs.
Right.
So yeah, our rates could be 70%, but
Well,
it's not.
one of the things that you could do too is if you pay the tax now, you could look to some of these tax-free alternatives moving forward, and then never even have to worry about the tax
Right.
again. So.
Right, and people, if they balance it out, you can have after-tax money and before and pre-tax money.
Sure.
So, have investments both sides, not just one or the other, and just kind of spread it out a little bit here and there, and instead of trying to just fund everything all at once with big dollars.
Right. Well, that's been our conversation with Mark. If you want more information about Mark, certainly Mark at Sterling Accounting and Tax. You're now in Phoenix.
Or now,
so-
I'm now living in Phoenix,
So-
driving a lot back and forth,
Right,
servicing
up in
the
Sedona.
V Valley and the Verde Valley.
Yeah, it's so funny because most people say, "Oh, Sedona, it's this beautiful place," but
It is. It's a beautiful place. It's a very beautiful place, and it's great to be in where there are conveniences in the city too.
Sure.
So-
Well, I got to tell you, selfishly, it's a little bit of an easier drive for me to see you here in Paradise Valley. So I really appreciate your time, and more importantly,
All right.
continued success.
Great.
Thank you.
Thank you.